Retirement planning is an ongoing process that needs to consider a lot of different variables to be done properly. So while an initial retirement projection might be a good start, you need to have a plan for when your assumptions are incorrect. For example, what if inflation is higher than you expect in the future? What if tax rates increase? These are just two of the 7 what if scenarios that I'm going to cover in today's video, as well as a few ways that you can plan ahead for those to ultimately reduce or eliminate any stress you have about the long-term success of your plan. Hey everyone, my name is Jake Skellhorn. I'm a certified financial planner and I own Spark Wealth Advisors with my partner Chris, where we help people retire with confidence and clarity. If this is your first time here, be sure to subscribe to the channel, share it with a friend, and leave a comment below if you have any questions. So to best explain these what if scenarios and the impact on your financial plan in retirement, we're going to take a look at our financial planning software and a couple of clients that we work with here at Spark Wealth Advisors. Their names have been changed, of course, for privacy reasons, and we simplified some of the numbers, but I think this will be the easiest way to visualize the impact of certain what if situations. So let's take a look. All right, so here's our clients, Katie and Kevin. They're currently age 66 and 64. Their initial retirement plan is to retire next year. I just want to give you a little bit of background on their investments and their savings before we dive into their retirement analysis. So this is their joint savings account. They have their primary residence paid off, and then Katie has her 401k with about $470,000. Kevin has a couple of retirement accounts with $300,000 in an IRA and a little over $660,000 in his 401k. So from here, let's look at their retirement analysis, which is essentially a Monte Carlo analysis. So if you're not familiar with a Monte Carlo analysis, it is a simulation of 1,000 different scenarios. So it's a projection using all the inputs that we put into the software here, such as Katie and Kevin's current savings amounts, how their investments are allocated, when they want to retire, how much they want to spend, lots of different variables. And it projects out using historical market data what the likelihood is that they're going to have enough money to live on for the rest of their lives given their current desired spending goals. So their initial plan when they came to us was 47% probability of success. So that's saying there's a 47% chance that they're going to have enough money to last the rest of their lives. Now, one of the issues that I have with Monte Carlo analysis is that it assumes that we don't make any changes from now until the rest of their lives. So the better way to frame it, in my opinion, is that there's a 53% chance that we're going to have to adjust something along the way to correct course to prevent the ship from sinking, so to speak. So either way, 47% is not really a good number that you want to start with. So we did make some adjustments for Katie and Kevin. We changed their investment allocation a little bit here. We changed when they're going to claim Social Security. We did explain to them that their chance of success is going to go up considerably if they retire just a year or two later for each of them. And then we introduced a different spending strategy in retirement called the Retirement Spending Smile that essentially slowly decreases their spending slightly based on inflation over time. So just with those few adjustments, we got them to a much more comfortable 80% probability of success or 20% chance that we're going to have to adjust something in their retirement. So we felt much more comfortable with that as a baseline. So in order to look at different what if scenarios throughout their retirement, again, retirement's usually a 30-year period. There's a lot that can change. So we'll do what we call a stress test on Katie and Kevin's retirement plan. So here we can play with individual different variables to see what if this happens in the future that we're not necessarily expecting. So these are their 7 what if scenarios that we're going to go into here. Number 1 being what happens if the market drops at retirement. So this is also known as sequence of returns risk. And again, sequence of returns risk is basically the risk that the market is going to take a significant drop as soon as you retire. So in this case, we're assuming the stock market goes down by 20% as soon as you retire. The issue with this is that you're still going to have to pull money out of your accounts to live off of. So you're essentially pulling money out of your investments at the worst time when the market is down. So in Katie and Kevin's situation, they still have a 71% probability of success, or again, about a 29% probability of adjusting something like a temporary cut in spending. Still a pretty solid number, nothing too concerning with that. For these what if scenarios, I'm going to explain the baseline assumption that we have in the software, as well as the what if scenario and how you can really plan around the what if scenario. So the baseline assumption for the market dropping at retirement is that it doesn't drop at retirement. The what if scenario is that the stock market drops by 20%. We plan for sequence of returns risk is typically by setting aside about 5 to 7 years of living expenses in lower risk investments like bonds or cash. That way, if the stock market drops, You don't have to pull out of those equity investments while the markets are down, and you give it plenty of time to recover in the long run. So the second what if scenario would be, what if taxes increase? So the baseline scenario in the software here is that it uses today's tax rates, but it also factors in the sunsetting of the Tax Cuts and Jobs Act. So in 2026, the Tax Cuts and Jobs Act is expected to expire. So tax rates will increase by default in the future. So that is the baseline. We already assume that in our software here. But the what if scenario is, what if taxes increase from that 20% higher? So it doesn't mean every tax bracket is going to increase by 20%, but for example, the 25% tax bracket would become a 30% tax bracket. So while there's not much we can do about the tax rates themselves, how we can plan ahead for that is by diversifying the tax status of your investments. In other words, spreading money out evenly between Roth accounts, pre-tax accounts, and after-tax or non-qualified brokerage accounts. So you have more control over where your income is coming from in retirement and more control over your tax bracket as a result. Another strategy is to do Roth conversions at today's historically low tax rates. That way you're locking in taxes today. And when you withdraw that money from a Roth in the future, it doesn't matter what the tax rates are because you won't pay taxes on it. So as you can see with Katie and Kevin's plan, they still have a 77% probability of success. Taxes are not a huge threat to their plan long term. The next thing we look at is the probability of Social Security being cut by 20%. So I know this is a big one that's on a lot of people's minds right now. It's been in a lot of headlines. So what if scenario here would be, what if Social Security benefits are cut by 20%? The baseline, of course, assumes that no cut is going to be made. But ways that you can plan ahead for this are by considering delaying Social Security so that your benefit to start with is even higher. That way the 20% cut doesn't affect you quite as much. You could also consider part-time work early in your retirement years. That way you don't have to touch your investment accounts as much and ultimately don't have to rely on Social Security as much when you retire. So Social Security being cut does have a pretty significant effect on Katie and Kevin's plan. So that's part of the reason we recommended that they delay until age 70 so that they get the maximum benefit. So if it is cut, it doesn't affect them quite as much. But this is one of those scenarios where a temporary cut in their retirement spending might be warranted. So this is one that we're going to keep an eye on for them for sure. The next what if scenario is longevity. So in other words, the possibility that you live longer than we're planning for. So according to the Social Security Administration, the life expectancy of a 62-year-old as of 2021 data is about 81 years old for a man and 84 years old for a woman. So that's the baseline assumption. In our software here, we actually plan for Katie and Kevin to live until age 90. So that's the baseline in the software here. But the what if scenario would be, what if you live 5 years longer than that, which would be 95. So this is another one that would have a pretty significant effect on their probability of success. It brings it down below 60%, which is starting to get into kind of dangerous territory. You know, there's a higher probability that we're going to have to adjust something. So one consideration and how to plan for this ahead of time is to consider a withdrawal strategy that slowly decreases spending over time, which is actually in line with how most retirees actually spend money. So going back to that retirement spending smile, instead of adjusting your expenses or your withdrawals with inflation every year, we can adjust it to inflation minus 1%. So for example, if inflation is 3% one year, instead of increasing your withdrawal by 3%, just increase it by 2%. And this really does a lot to stretch out your money over a longer period of time. Next what if scenario is, what if inflation is higher than normal? So the baseline assumption in the software here is that inflation will be 3% over the long run, which is historically about what it has been. But what if inflation is higher by 1%? What if it's 4% over the next 30 years? A couple ways that you can plan ahead for this and combat inflation would be to make sure that your portfolio is invested in a way that it's going to keep pace or outpace inflation. So historically, the stock market returns have been about 3 times the rate of inflation. Obviously, volatility is the price that we pay for those higher expected returns in the stock market, but that volatility can be dampened with bonds in your portfolio. Health expenses are a big thing that people underestimate in retirement. According to a study done by RBC Wealth Management, the average 65-year-old expected to spend about $2,700 per year on healthcare expenses in retirement, but experts say in that study that it's closer to $5,700 per year per retiree. So our baseline scenario in our software here is that you spend about $6,000 per year as a healthy 65-year-old in retirement, and that does increase with inflation each year, of course. So as you can see in Katie and Kevin's plan, it doesn't affect them too much. They're still at a 71% probability of success if their healthcare costs are expected to be 20% more than that baseline of $6,000. Ultimately, all you can really do to plan for this is to use conservative estimates. Again, we use about $6,000 per year per retiree. Based on that study done by RBC Wealth Management, that's more than their estimate of about $5,700. Beyond that, all you can really do is lead a healthy lifestyle, exercise in retirement, eat as healthy as you can to, reduce your healthcare expenses long term. And lastly, you need to be prepared for your investment returns being lower than expected. So the last what if scenario here for Katie and Kevin is, what if your expected portfolio return is 1% less over the long run each year? The expected return we have for Katie and Kevin's portfolio, which is about a 60-40 equity to fixed income portfolio, is about 6.6% on average long term. You can plan for this by using conservative estimates like we do. The long-term average return over the last 30 years for a 60-40 portfolio is closer to 8.5%. So by starting with more conservative estimates to begin with, it's less likely that you're going to undershoot the actual returns of the portfolio. You can also plan for this by monitoring your portfolio consistently, rebalancing when appropriate to make sure that you're in the right allocation and you're staying in line with your expectations for your investment returns. So whether you're a DIYer for your retirement plan or you're working with a financial advisor, make sure you're considering all of these what if scenarios so that you do have a plan if one of them or all of them come true. Again, the point of this is to have a plan ahead of time, reduce your stress so you can ultimately lead a more fulfilling retirement. If you enjoyed this video, be sure to subscribe and share with a friend, and visit us at www.sparkwealthadvisors.com to learn more about what we do for our clients. Thanks for watching.